Hello everyone, my name is Tobias Ocheng. I'm going to take you through BAF 1101, Introduction to Financial Accounting, or Financial Accounting 1. In our previous lesson, we explained some important terms used in accounting. We also looked at the accounting equation. If you remember the equation, assets is equals to capital plus liability. Now today, I need to show you how to record transactions. So we are going to learn recording transactions. Now that part of accounting that deals with records is called bookkeeping. And the importance of accurate and complete records cannot be emphasized enough. Think of this scenario. You run out of cash, you go to your bank, and they tell you they don't even know you because they didn't keep your records. You would be disappointed. Another scenario, if you run out of an item that you need to use urgently, and you go to the supermarket, and you find the shelf empty. On further inquiries, you are told that they didn't even know that their shelves are empty because they didn't keep records, so they didn't replenish the stock. In that case, you will be disappointed, and the store itself will have lost some money, and maybe also a loyal customer. So these two examples illustrate the importance of keeping records. So in accounting, we have to keep records, because without accurate information, we cannot make any decision. So the records will help us to know who owe us money and the amount of money they owe us. We are going also to know from our records whom do we owe money and how much do we owe them. From our records, we are also going to know how much profit we made in a particular period. So contrary to popular opinion that accounting is just about numbers and calculations, accounting actually is about information for decision making. And to make a decision, we must have records. That is why today's lesson is very important. Remember, the accounting equation has two sides. The assets, which are the resources of a business, and the other side, capital and liabilities. Why are these two sides equal? It's because they are the same things that we are looking at from different perspectives. On these sides, it's assets, what they are. And as we said last time, assets are just resources of value in a business. So these are resources, what they are. It could be vehicles, buildings, computers. This side is who provided the funds to obtain them. So if the funds were from owners, then that is capital, sometimes called equity. But sometimes the owners do not have enough money to acquire these resources or assets, so they have to borrow. And in that case, we get the liability. Let me give you an example. If your business needs to buy, for example, a truck, which costs 6.5 million, and you as an owner, you only have 4 million, you may need to borrow 2 million from the lenders. So these are resources. Your truck, what it is, its value is 6.5 million. But who provided this 6.5 million so that you acquired it? Partly from yourself and partly from lenders. So when we are recording transactions, we must do it to show these two perspectives. And that is what is called double entry. So as we have seen, the phase of accounting of record keeping is called bookkeeping. But the system that we use is referred to as double entry. So because of this, some people use those two terms interchangeably, double entry or bookkeeping. So that is what we are going to see today, how to record transactions. Now, transactions in accounting are recorded in what we call ledger accounts, sometimes called T accounts because they look like a T. So this is what we are going to use to record transactions. On this side, it's called debit. This other side is called credit. So if you record on this side, we say that you are debiting the account. If you record on my right, then you are crediting the account. There are some rules to follow to know where to record a transaction. You have to write the name of the account, first of all. You will show the dates and then the amount. So I'll share with you the rules to be followed when recording transactions. Now these are the rules. If you have an asset account, any asset account, if there is an increase in an asset, you debit the account. If there is a decrease in an asset account, you credit the account. For a liability or capital account, an increase is credited and a decrease is debited. So those are the rules. We keep referring to them until we become accustomed to them. So I'll take you through an example of how to record capital, liability, and assets in T accounts. So look at this example. It says there you are required to open the assets and liability and capital accounts and record the following. So we are given a number of transactions and we are required to record them in a ledger account. This person started business on June 1st with 12,000 shillings. Now the money used to start a business, which is contributed by the owner, is called capital. So what accounts do we need to open to record this? As we mentioned before, each transaction has a dual effect. It must be recorded twice because it must show the assets and the other side, the claims against the assets, who provided the funds for that asset. So in this case, on June 1st, when a business is started with 12,000 shillings, then we open a capital account. And the owner has contributed the money in cash. So we are going to open two accounts. What you need to do is to draw those two accounts, the T accounts. We will call that one capital account. You write the name of the account on top, and then cash account. So how much is involved? 12,000. Remember we said that any asset, if there is an increase, you debit it, and cash is an asset. So we are going to debit. Debit is the left side of the account, 12,000. You need to show the currency that you are dealing in. Here we are going to show the date. So that was June 1st. If you remember those rules, let's just go back to them. If there is an increase in capital, we credit. So there is an increase in capital, 12,000. So we need to credit. That is 12,000 here. Show the currency also. Show the date. That is June 1st. So this is double entry, which is now complete. But we need to show the details. What is this money for? And where did this money come from? So you interchange the name of accounts. So here you write capital. And then the other side, you write cash. So this capital is in terms of cash, and this cash is for capital. you interchange the name of account. So this is double entry, and now the recording is complete. At a glance, you can see that you have 12,000 capital in terms of cash, and in cash, you can see that you have 12,000, which is capital. So let's go to the next transaction. On June 2nd, what happens? The business paid 11,700 of the opening cash into a bank account for the business. So for each transaction, determine the accounts involved. And as we have emphasized before, each transaction has a dual effect, is what we call double entry. So in this case, the accounts involved is cash, but then we have another account now called bank. Money has been moved from cash account into a bank account. So whenever you use cash account, don't draw a new one. If you already have one, all the transactions that requires cash will just pass through that same account. But let us introduce the bank account. So here we have bank account. Bank is an asset, okay? And let's go back to the rules. If an asset increases, how do we record it? So an increase in assets, we make a debit. So let's find out the amount of money involved. 11,700. Show the currency, 11,700 here. The dates are very important, so you must show the date. This happened on which date? If you look at the question, on June 2nd, isn't it? June 2nd. So this is just one part of the record keeping. Where will I complete the double entry? So this money came from where? From cash. So you have to go back to your cash account and record it. So if money is being moved from the cash account, is that an increase or a decrease? That obviously is a decrease of cash. And let's go back to our rules. When there's a decrease in an asset, what do? We credit. So we need to credit the cash account with the same amount that went to the bank account, okay? This is on June 2nd. This is on June 2nd. So this is the double entry, but we need to show the detail column where this money went. It went to bank account. So just interchange the name of accounts. Write bank here, and in the bank account, we write cash. So the double entry is over for that particular transaction. Let's go to the next transaction. On June 5th, what happens? The business bought office furniture on credit from Dream Limited for 1,900 shillings. So there's a new asset called office furniture. Open an account for that. Office furniture. What will be the other double entry that is required? We bought it on credit. That means we have created a liability. We are owing Dream Limited. So we open an account to show Dream Limited. Now this is a liability. Okay? So how much is the furniture? If you look at June 5th there, it's 1,900. You have to show it here, the currency, and also the date. That was on June 5th. This office furniture is an asset. So an increase in asset, as the rule says, is debited. To debit means you record it on the left. Then we are owing, so we have increased the liability. Any increase in liability, let's go back to our rules again. An increase in liability must be credited. So let's credit that, 1,900. Show the currency, show the date as well, June 5th. So for the double entry to be complete, now we have to show the column, the detail column. So here, this money or this office furniture came from Dream Limited. And we are owing Dream Limited because of office furniture. Just interchange the names of accounts. And if you have noticed so far, for any debit entry, there is an equal credit entry. So that is what we call the double entry or the double entry system of bookkeeping. Now let's go back to the equation and look at another transaction. Look at this transaction on 8th. What happens? The business bought a van by check, 5,250. So you need to create an account called van account. That is an asset. That is an asset. But to complete the double entry, you need also to record the amount of money used to buy this van. Where did it come from? And the transaction says by check. So if we write a check, our bank account will be involved. But a van is an asset, and an increase in asset, go back to your rules again, an increase in asset must be debited. So we debit this van asset by how much? Look at the transaction on 8th, 5,250. 5,250. Write the date. The date is on 8th. That is June 8th. But since we paid by check, that means there is a decrease in our bank balance. And look at your rules again. When there is a decrease in an asset, what do? We credit. Okay? Also, you can see that if this is debit, the other one must automatically be credit. So let's go to our bank account and credit that money. 5,250 on 8th of June. Now, what do we write in the details column? This money went for van, and then in the van account, we know that this was paid by a check, so it has affected our bank account. Okay? Now let's go to the next transaction. Let's go to our next transaction. That is on 8th. We go to 12th. Something happens on 12th. They bought equipment from Pierce and Sons, and they did it on credit. So equipment being an asset, this account will have to be debited. Open an equipment account and debit it with the amount, the value of the asset. Now look at it. How much is it? 2,300. And it was bought on credit. From who? Open that account. Open that account. This is our creditor now. We owe him. This is a liability. Pierce and Sons. Huh? Go back to your rules again. How do you record a liability? An increase in liability. An increase in liability is credited. So you have to credit that, 2,300. Show the currency. Show the date as well. When did this happen? It's on 12th, 12th of June. So June 12th, we used 2,300. We bought equipment worth 2,300 on credit. Then interchange the name of accounts. We owe this person because of the equipment. This equipment, how did we obtain it? From Pierce and Sons. Suppose we had bought it on cash, then I would have written here cash, and then I would have gone to the cash account and credited it to show a decrease in an asset. Let's go to the next transaction. Let's go to our next transaction. That is on 18th. Returned faulty furniture costing how much? 120 to Dream Limited. So our liability to him is decreasing. The amount that we are going to pay him will decrease by that 120. So a decrease in liability, how is it recorded? Look at it. A decrease in liability must be debited. So we go back to that account. That account, that is on 18th, Dream. We had a Dream account somewhere. Yeah, here. So debit it by 120 to show that now our liability is decreasing. Because what we are going to pay him, since we have returned part of the furniture, is less by 120. So you need to debit this Dream account. It is a liability account. We are owing them. Where does the double entry take us? Furniture. Okay. Now, furniture being an asset, we had furniture worth 1,900. Now, if we return some, then there is a decrease in furniture. And let's go back to our rules. When there is a decrease in an asset, what type of entry do we make? Look at it, number 2 here. A decrease in an asset, we make a credit entry. So let's credit that amount, 120. Here we show the date. When did this happen? Let's go back to the question. On 18th of June. So 18th June. 18th June as well. So to complete the double entry by showing the details, then just interchange the name of accounts. So here you're going to write office furniture. And here we write Dream Limited. So this information now is complete. Let's go to the next transaction. Our next transaction is on 25th. Sold some equipment for 200 shillings for cash. Let us determine which 2 accounts are involved. The equipment and also the cash. What is the effect on cash if we sell? That means we are receiving this 200. Cash being an asset, there is an increase in asset. Equipment is also an asset, but in this case there is a reduction in asset. So we are going to, let's look at the rules again. You keep referring to these rules until you become acquainted with them. If there is an increase in asset, we debit. So we are going to debit cash account, and we are going to debit, credit another asset account, which is equipment account. So just look at them. Where is our cash account? Here. So we are receiving 200. So you debit that because there is an increase in asset. What about equipment? Look at equipment account. There's a decrease in equipment, so we are going to credit that. How much is it? 200. 200 shillings. Let's show the date. This transaction happened on which date? On 25th of June. 25th June. So interchange the name of accounts. This is cash. And then let's go to cash account to explain where this money came from. Is by selling equipment, isn't it? Equipment. Show the date. Dates are very important in accounts. So that is on 25th, isn't it? Now let's take our second last transaction. Paid amount owing to Dream Limited, 1,780. What is the effect of this transaction? Dream Limited is a liability. We owe him money. So when we pay him, we are reducing a liability. Okay? But we are using a check, meaning our bank is also affected. There is a decrease in our bank account. A bank is an asset. So let's go back to our rules. How do you record a decrease in an asset? So for the bank, because it is a decrease, we are going to credit that. So let's go to our bank account. Look at your bank account. There's a decrease of 1780. So you credit that, 1780. Okay. Where did it go to? Oh, to Dream, isn't it? So you debit this, 1780. Interchange the names of accounts, say Dream here. This was paid to Dream. And show here bank. And then you need to show the dates. Let's take our last transaction. Our last transaction. That is on 28th. On 28th. What happens on 28th? Took 130 shillings out of the bank and added to cash. So in our bank account, there's a reduction by 130. So if you go back to your rules again, go back to your rules. If there's a reduction in an asset, you credit the asset account which is involved. So let's credit 130. And where did this money come from? Said cash. Just interchange the names of accounts. Go back to cash. So what did the transaction say? Let's just remind ourselves. The transaction on 28th took 130 out of bank and added to cash. So there's an increase in cash, 130. Where has it come from? Our bank account. And that shows how to record assets, capital, and liability. This is what we call the double entry system. Okay? Now, there is a very important asset called stock. There is an important asset called stock. I want to show you how to record stock. So already we have seen how to record assets. We have seen how to record capital. We have also seen how to record liabilities. Liabilities is when the business is owing outsiders. So for assets, what we said is that if there is an increase, you need to debit. To debit is to record it on the left side of your T account. If there is a decrease, for example, you have paid some money, then you credit. Okay? So this is for increase. This is for decrease. Okay? For capital and liabilities, it's the opposite. If there is an increase, then you credit. That is with an increase. But if there is a decrease in liability or capital account, we need to debit. So these are the rules of double entry for decrease. Okay? But now I need to introduce a very important asset called stock. For good reason, we don't have a stock account. But the stock account, as any movement in stock, has been shown in 4 different accounts. So which are these 4 accounts? The movement in stock is shown using these 4 different accounts. There is the sales account. If you sell any stock, you record in sales account. From our point of view, an asset of stock is decreasing when you sell. Okay? Then, when you buy this stock, which you are selling, you open purchases account. Okay? So purchases account is for recording what we have bought for the sole purpose of reselling. So these 2 accounts show the movement in stock. We don't have an account called stock, but any movement in stock is recorded in 4 accounts. The 2 are sales account, purchases account. The third one is called sales returns. That is, we had bought some goods, but we are returning them from where we bought them. for one or two reasons. Maybe they did not meet our specifications. This sales returns accounts is also called returns outwards accounts. And the fourth one is, the third one is people who have bought from us are returning, for one or two reasons. But we can also return what we had bought. So that is called purchases returns. This is inwards. Sales returns is returns inwards. Change this, inwards. Purchases returns are returns outwards. So from our point of view, the stock which we had bought is reducing because we are returning some from where we bought them. So this is also called returns outwards. Returns outwards. Let's just go over them again. The account of stock does not exist. Instead, the movement in stock is shown in these four accounts. When we sell, we open a sales account. And from our point of view, it means that an asset of stock would be reducing. And from the rules that we started with, if an asset is decreasing, then we credit. So that would mean that sales account would be credited. Okay? When we buy stock or inventory for the sake of selling, reselling, we open purchases account. From our point of view, there is an increase in an asset. And hence, purchases account is always debited because it is an asset. The third one, sales returns. We had already sold, but our clients or customers are returning for one or two reasons. It is also called return inwards. From our point of view, there is an increase in an asset, and therefore this will need to be debited. The last one, when we had bought some goods and we are returning them, from our point of view, there is a decrease in an asset, and hence we need to credit because there is a decrease in assets. Now, before I give you an example to show how these accounts are posted, I need to emphasize the meaning of purchases and sales in accounting. In common language, when you buy anything, it's called purchases, and when you sell anything, it's called sales. But in accounting, these two have special meaning. What do we mean when we say purchases? This is purchase of those goods which the business buys with the prime intention of selling. We could change them, add some value. We can even use them in manufacture, but the element of resale is what is looked at to know that this is purchases. So if you deal in computers and you buy computers, that's purchases. But if you buy a van to deliver these computers to your clients or your customers, that is not considered purchases. It's just acquisition of a fixed asset. So we are using the word purchases in a restricted way here. Same to sales. It means sale of those goods in which the business normally deals and which were bought with the prime intention of resale. So maybe you have used your van for a long time and you need to dispose it, and you don't normally deal in vehicles. That's not considered a sale. Okay? So that's important, that distinction. So let's take our next example that I'm going to use to illustrate how to record transactions involving stock. Look at it. This business bought goods on May 1st on credit worth 220 shillings. Because we bought goods, which account do we open? Purchases. So let's open our purchases account. And as we mentioned before, each transaction has a dual effect. So how is the double entry completed? Where did we buy it from? From D small. Now, how much were these goods? 220. So we are owing D small 220. This small in accounting is called creditor. The person we are owing for the supply of goods. And it could also be called accounts payable. Creditor or accounts payable. So this is a liability. This is our asset. So just write the date and then interchange the names of accounts. So when did this happen? 1st of May. We have 20x9, May 1st. You need to write this so that it lines with the data. Let's do the same here, May 1st, 220. So interchange the name of accounts. So here write the purchases. Remember, all these records are in our books, but we have to show them twice. They are in our accounting books. This small here. So now this is a complete double entry. Let's go on to the second one. Bought goods on credit, 410. So it's purchases again, but now it was bought from Leon and Son. The goods are worth 410 there. When did this happen? On 2nd of May. So we are owing Leon. This is also a creditor, or it's an accounts payable, 410 on May 2nd. So how much? 410, yeah. Interchange the name of accounts. These purchases are from Leon. And Leon, we are owing him because of purchases. Okay, let's go to the next transaction. The next transaction is on 5th. Sold goods on credit to D Hughes, 60. Now, look at our 4 accounts for movement of stock. Look at our 4 accounts for movement of stock. Let me show you on the slide. So if you sell goods, you open a sales account. So let's open that. Sales account. And since stock is an asset, and when you sell, there is a movement out, there is a reduction, we need to credit by that amount. Let's just look at the amount involved on June 5th, 60. This is shillings. This is, when is the date? May 5th. You sold it to who? You sold it on credit to D Hughes. So this is called a debtor. It's an asset. He owes us money. So a debtor is an asset. It's also called accounts receivable. Accounts receivable. So this being an asset, there's an increase in asset. 60 on May 5th. So just interchange the name of accounts, shows sales here and here, so D Hughes. Let's go to the next transaction. That is on 6th. Sold goods on credit again to M. Spencer. So that would be the same. Sales. How much is it? 45 shillings. On which date? 6th, May 6th. But now to a different person called Spencer. So we have another data. We have another data. So you open that data account. This is an asset account. There's an increase by 45. Interchange the name of accounts, show their sales, and then the dates, very important in accounting, must be indicated. That happened on when? 6th. 6th. Let's go to the next transaction. Returned goods to this mall. So these are purchases returns, because we bought from him. Now we are returning. How are we going to record this? Do you remember the rules of posting into the T accounts? Let's just revisit them. When there is an increase in an asset, we debit. When there is a decrease in an asset, we credit. So, if we returned some goods, what do you think? Is there an increase in asset or a decrease? From our point of view, there is a decrease, isn't it? So we returned goods to this mall. So we should open a return out or purchases return. The two names can be used interchangeably. Purchases returns or returns outwards. So you need to credit this because there is a decrease in an asset. So that would be how much? This mall 15. On which day? On 10th, May. Is it June or May? May 10th. How do we complete this double entry? How do we complete this double entry? Go to this small account. I think we have it somewhere. And then our liability to him is decreasing. So a decrease in liability is debited. So we need to debit by that same amount, 15. Interchange the names of these accounts. This is returns or purchases returns. Purchases returns. Remember, you can also call it returns outwards. And then the return outwards, you will show this small. Don't forget to show the dates. D small. Let's go to the next transaction. Let's go to the next transaction. That is on 11th. Huh? What happens on 11th? Goods sold for cash. That is incomplete. No, it's okay. Goods sold for cash, 210. So, sales again. Sales again, 210. But in this case, it was not bought on credit, so we don't have a data, but for cash. So we go to our cash account. Do we have it? If it is the first time we are using it, you open it. Cash account. Cash is an asset. An increase in asset is debited. So on 11th, we have received 210 from sales. 11th of May. Let's see our next transaction. Goods sold for cash again, 175. So you will record it in the same way. Sales, credit sales with 175 shillings and debit cash with 175 shillings. Just use the same account for cash. So we'll have 175 here, sales, and on the sales account we will have 175 credited. Let's go to 22nd. What happens on 22nd? Paid cash to this small. Now when we pay cash, it means our asset of cash is decreasing. How do we record that? We credit. So how much is involved here? 205. 205 there. And then to complete this double entry, where did this money go? It was used to pay this small. So you open a this small account. We already have it. And because that was a credit, this must be debit. 210 cash. Okay? The next transaction, I think it's our second last one. D. Hughes paid the amount owing by him 60 shillings in cash. So cash, again, is increasing by 60. D. Hughes complete this double entry in the D. Hughes account by crediting it. So here is 60 cash. You have to show the date there, which is 30th of May, or May 30th. Our last transaction is on 31st, bought goods on credit. So we go back to purchases. Let's go back to our purchases. How much is involved here is 214. 214. But it's from who? Leon and Son again. Remember, we have this account, so we have to show it on the same account here. 214. And the date is on 31st, the last day of May. May 31st. Interchange the name of accounts, write purchases here, and then Leon and Son here on May 31st. So that is how to show movement in stock. We use those for accounts. Now I want us to end it here. Next time when we meet, I'm going to show you how to enter transactions involving expenses. How do you record expenses? Because for today, we looked at how to record assets, how to record liabilities, how to record capital. And just to recap, assets, any increase in asset is debited, any decrease is credited. Okay? So here is decrease, and here is increase. A liability account or capital account is the opposite. Any increase is credited if there is an increase, and debit if there is a decrease. So we have looked at this. We also looked at a special asset called stock, whose movement is recorded not in a stock account, but in 4 different accounts, namely sales, purchases, returns outwards, and returns inwards. So next time, we are going to look at how to record expenses. You have paid electricity bill or water bill. How do you record that? Or income. You have received some money, not sales. Maybe you have rent receivable. Okay? So that is called income. How do you record this? After that, I'm going to show you how to balance off these accounts, and then how to extract what we call trial balance. Thank you.